podcast. Today is the fourth quarter 2025 Vaughan Nelson Select recap. And with me today is lead senior portfolio manager, Scott Weber. And with that, Scott, I will turn things over to you.
Thanks, Dan. So to wrap up 2025, for the quarter, the portfolio was up a little bit. It was up nicely for the year. I would say that relative performance wasn't as strong, given that the market performance remains really concentrated in just a few names. By way of example, and I think this is interesting, if you isolate the top and bottom 10 contributors to the index in 2025, we, at least for some portion of the year, we owned 7 of the top 10 contributors and only one of the bottom 10. Now, in a typical year, owning just a couple of the top performing names in the index is enough to generate alpha. The last couple of years haven't exactly been typical. The few names that are driving index performance are still largely concentrated in companies that benefit really from AI capex, and that theme's definitely, it doesn't seem to be over. History, of course, suggests that it will not continue indefinitely. And we have chosen pretty carefully our names and our exposures there. And we're going to remain vigilant in monitoring the pace of the progress there in each individual name. It won't last forever, but we're going to be keenly focused on it and participate for as long as it does. So, wrap that up. And I would say it probably wouldn't come as a surprise to anyone to see that theme evolve. Certainly wouldn't surprise us to see that theme evolve a little bit in 2026 from a CapEx foot race into productivity growth winners, inference, and other areas where it's not just can you spend more money. So we're working on that, and we'll, broadly speaking, absolutely continue to seek out underappreciated idiosyncratic return opportunities, all with our expectation of positive asymmetry. Looking at attribution for the quarter, the healthcare sector really led the way. I'll call out Eli Lilly for being a notable contributor there. Energy financials also did well, notably Exxon and Capital One, which is a newer addition. Each of them were newer additions. Um, Technology and industrials lagged. Motorola was a drag. We sold it. Broadcom and Eaton also were drags. We for a while owned Spotify and it did well, but in the fourth quarter, it also was a drag on our telecom services. It also was sold. So in total, we eliminated 5 positions and we added 5 new positions in the quarter. So from a trading perspective, a little bit, just a little bit busier than normal. Um, the resulting portfolio resembles the index from a characteristics perspective. If it's maybe just a little bit larger on the market cap and a tick higher on a PE or price to cash flow basis. However, if you use the FactSet estimates for 3 to 5 year earnings growth, we've got a lot more earnings growth according to that data. So hopefully that's going to come through for us. Generally speaking, higher expected growth at a comparable valuation coupled with greater factor diversification should be a winning formula for alpha creation. We definitely own a number of the same names that are big in the index, but the portfolio itself has much greater factor diversification. We've got higher ROAs, higher ROE, and active share in the mid 60s. You'll note that that mid 60s number is a little lower than it's been a bit, and we've trimmed our active exposure just a little bit. And I would say not as something that we set out for its own sake, but basically so that we can better compete with the index on a relative basis. Looking at the factors and their contribution to the performance of the portfolio, it was really broad based. There were not any bombs, so to speak, or pitfalls or anything like that. So generally speaking, stock specific was the detractor from relative performance. The style returns that dragged were we started off a little smaller, ended a little higher, and we're a little less on the dividend yield relative to the index. Uh, and then from an industry perspective, it was positive. Software and semiconductors contributed positively. We do own a healthy position in semiconductors, so that was a good number. In aggregate, the portfolio active risk is about 4.46%. That's typical, nothing surprising there. And stock specific risk accounts for 74% of the active risk of the portfolio. Of course, The inverse to that is systemic risk accounts for about 26 of the active risks. So, again, still very much an idiosyncratic led portfolio. Names that really helped there: Taiwan Semi, I mentioned Eli Lilly, Monolithic Power. Not owning Tesla helped. And then from a systemic standpoint, the semiconductor exposure, market sensitivity, and to a lesser extent, because we own Taiwan Semi, the country of Taiwan shows up as a country of risk, even though so much of their revenue is really U.S. delineated with, global certainly, but heavily exposed to the U.S. Um, Flipping now to the macro and the positioning, it's funny. I've had several clients and friends ask me essentially the same question or have the same subject, which is there anything that can make this market go down? You know, recall that we had a government shutdown. We've got an ongoing battle between the president and the central bank leadership. We toppled the leader of a country. There's been a lot really to throw at the market, and nothing seems to rattle it. And the tone of the question, "Can nothing make this market go down?" I think is belying of sentiment that's really perhaps misguided. And by that, I mean, if you look at some of the fear gauges within market data, whether it's the VIX, the implied vol, or the move index for bonds, et cetera, none of those would suggest that we're at a near term, risk uptick. Um, and so that market sentiment is probably overlooking some of the bright spots that are fueling the gains in stocks. To wit, we have growing liquidity from several central banks, our own included. China is another one. We've got pretty easy comparisons. I remember, don't forget we had Liberation Day early last year, the whole DeepSeek thing. We now have a reducing regulatory burden, not just in financials and banking, but across multiple industries. And so the economy really kind of seems to be clipping along pretty nicely. It's true that lower income consumers are facing elevated food and energy costs, but the tariffs, that were such a, I don't know, harbinger of mood in mid spring last year, they've not really released an inflationary wave that many people feared. There might have been a step function up in the price of certain goods, but it's not snowballing and getting out of control. Um, Although, ironically, without the tariffs, we probably would have had a Fed that was closer to its target rate or target inflation area, and maybe a little bit higher because of the tariffs. But all in all, it's not stopping investment. And so upper income consumers tend to be doing well. The wealth effect is strong. The market is up. And spending for CapEx is pretty strong. As we mentioned before, not just in AI and technology, but really that spreads across multiple sectors and geographies into other industries and has been a notable, perhaps meaningful contributor to GDP growth. So we're going to watch that. Again, it's not clear that AI capex in particular continues a rapid acceleration. It may decelerate a bit. Its growth, the growth rate may decelerate a bit this year, but at the moment, that capex, the broad industry, the broader industries adding investments, and the added liquidity coming from central banks really should be sufficient fuel for stocks in the first quarter. So the recent broadening that we've seen, really not in the fourth quarter so much as into fourth quarter into early January here, that broadening of market performance, I think should also be taken as a bullish signal, and it tends to help our relative performance as a strategy as well, and we're positioned accordingly. So, with that said, I don't own a crystal ball that's any clearer or more determinant than anybody else's. But those are the conditions as we see them, and we've positioned the portfolio accordingly. And we're looking forward to a good, strong first quarter of 2026. With that, Dan, I'll hand it back to you, and I appreciate it.
Okay, great. Well, thank you for all that color, Scott. And we'll move over to returns. So, in the fourth quarter of 2025, the Von Nelson Select strategy returned 0.29% gross, 0.03% net, and the S&P 500 was at 2.66%. Which brings it 1 year, the full 2025, to 14.3% gross, 13.17 net, and the S&P sits at 17.87. Over the past 3 years, the Vaughan Nelson Select strategy has returned 16.05% gross, 14.91 net, and the S&P 500 is at 23% even. Over the past 5 years, Vaughan Nelson Select strategy is at 13.06% gross, 11.95% net. The S&P 500 is at 14.42%. And finally, over the course of the past 10 years, the Vaughan Nelson Select strategy has grossed 14.18%, net net 13.05%, and the S&P is at 14.82%. And with that, that's a wrap on the fourth quarter. It's a wrap on 2025. So thank you so much, Scott. We'll have you back soon.
Thanks, Sam.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.